Yeah, near the end.
Near
And
the
we'll
end.
unmute. Okay. Let me share my screen here. What a freaking week. What a week, actually. I don't think we've had a debrief since July 4th week, so this is crazy. It's been a crazy time of volatility and stupidity on my behalf. All right. Are you recording?
Recording.
Oh, we're going to have to edit it then. All right.
No mulligans here, buddy.
Boop. Screen should be up. Thanks for joining us for another live session. Like I said, it's been a crazy week. So what we'll talk about today are selling options. I know that the skill level of the options traders and shares traders on our Discord are varied. So we will do a brief overview of options basics. We'll go over what that is, what that looks like. If you have questions, like Josh said, just throw them in the chat, and we will get to them. I'm gonna make sure that the screen's clear. Screen look clear? You can read it.
Roger that.
Killer. Okay, so my name's Void. This was originally supposed to be the Void and Rin show, but Rin bailed on us tonight, so prod him and give him hell for that. Like I said,
fuck that guy.
Hey, hold on. Let's do it. Actually, I couldn't find any scotch, so I'm gonna finish off a bottle of Basil Hayden. Not all at once. So I just got off the lake today, so I've already been drinking a little bit. So forgive me. So my name's Void, right? I've been doing options for about 5 years. Before I got into options, I got into options around COVID, during COVID. Before that, I was like, I don't need options. They seem complicated. The crazy thing was later I found out I could have been doing options this whole time, either buying and trading them or selling them, right? And I had made a lot of money slinging shares, swing trading, and things like that, but I was always like, options seem too risky. So I've been investing in trading for the last 25 years, but only doing options trading for the last 5. And just like trading in general, I'm always learning new stuff. But a lot of the things I've learned over the last couple of years are not just because they're options. It's because of technical analysis and other skills, especially smart money concepts, coming into play when I'm looking at how I want to position in the options market. I kind of look at the options market as an entirely separate second stock market, just driven by the underlying, right? That's kind of how I look at it. It gives me a way to compartmentalize it in my own mind. So by the end of the session, you should have a good understanding of the basics of options, some strategies that you can use maybe right away, depending on your portfolio, your risk level, and your comfortability with managing options trades. So we'll talk about that risk management. We'll talk about writing options, selling options, covered calls, cash secured puts, and spreads. We're not going to dig into spreads too much, but you can always find me on the Discord if you want to chat more about it. I'm slinging spreads like almost every day. We'll look at some real world examples. I'm going to go over what Ren sent, but it was FedEx earnings, MU earnings, which I also did. So we'll talk about that. And then he also had Rivian, which, fuck Rivian. So, and then the final couple I'm gonna do the S&P. I'm gonna show you some Tesla plays that were right before the July 4th hectic week, and then some that are actually happening and unfolding before our eyes right now. I actually just got out of a pretty hairy covered call situation, but yeah, that's what we're gonna do, and then we'll recap it, do some Q&A, and we'll talk about some best practices and managing them. And if you have questions, like we mentioned, drop them in the chat and we'll get to them. So let's talk about what options actually are. Options are those extra contracts I mentioned that were like a totally separate stock market in my mind. They're derivatives that give the buyer or the seller control of 100 shares of an underlying asset. So they're governed by a strike price, a premium amount, and an expiration date. The strike price is the price at which the option can actually be exercised. The premium is the price paid or received from an option. And then the expiration date is when an option expires. So understanding these key terms is crucial, especially when you're selling options, because you don't want to get the wrong expiry date and have your capital tied up for a while. We'll talk about why that's a big deal. But obviously, when you're buying options like we do every day in the Discord, you have some experience with selecting a strike and paying for premium. The great killer feature, in my opinion, of options, and something that's brought my portfolios back from certain death multiple times based on some really stupid trades that I go off and do on my own, is the ability to sell options. So that premium, receiving that premium is what I really like doing. What's the saying? There are always these stupid sayings we do during these huddles, but one's like "be the bank," right? I think it's "be the bank." So when you're writing options, you are turning your portfolio, your free cash, into a bank. You're basically loaning the options market uh, the potential to get your money, but you're not gonna get this. Can't have this, like Borat. All right, next. So understanding call and put options, I mean, this is pretty self-explanatory, right? When you buy a call, you think the price is going to go up. We've been doing that every day. And typically the price is going up. We're making some money. I had some good trades today. I had some bad trades today. I had an NVIDIA trade where I bought a call for 130 and it decided to go the other way. So yeah, not great. Selling a call is bearish. It means that you think the price will go down or stay flat. Buying a put is also bearish. You're betting that underlying is going to go down, that the stock is going to go down, and then selling a put is that you're bullish. You think the stock is going to recover from wherever it's at right now. There are different strategies of when to sell a put, just like there are strategies to when to sell a call, but you think it's going to go up or stay flat. And so your goal is to benefit from that theta decay, which another term we probably should have put on the previous slide is theta, which is the time. You'll hear us talk about theta decay even when we're buying a call, right? If we buy a call for Tesla today that's for 300 and Tesla never gets anywhere near 300, that call will eventually just fade into nothingness by expiry because the theta ate all the value and it never there was never any momentum to cause the price to increase beyond that innate theta value. So why sell options? The real reason here is because we like money, right? You basically get money up front when you sell an option. They put it directly into your account. If you're selling options and you're buying options, selling gives you that hedge, that inherent hedge that you can kind of fall back on. Like, well, today I lost that NVIDIA call, but I sold some NVIDIA puts when it went down to 128, so I made bank. I didn't really, but I could have, right? Do some more whiskey. Selling options is a different way to generate income compared to other strategies like just buying and selling shares, obviously. But the key thing for selling options, again, is you're gonna need capital. One thing I don't cover maybe in this is just talking about the capital intensity of selling options. I will dig into that. And then when you sell the option, you actually get to set the parameter of the trade. We'll talk about managing the position in a few minutes, but you're in control. And if it goes green or it is green, hopefully that's why you made the deal, because you know it's going to go green. But you get to set the parameter. You get to decide if you're in or out. And like we said, the main benefit here. Sorry, should have switched slides. when you sell the option, you receive that premium. It's yours, right? Regardless of if it goes up or down, you still get the premium. Now, you might spend that premium on buying back the contract that you sold, right? You might do that. That's one way to manage risk. When you sell covered calls, you might spend that premium buying back your shares that got called away. Another part of risk management. So, risk management. Here we go. So, options selling to hedge. It can be a great way to generate that passive income. You already know you're selling. You're trading shares. You're gonna hopefully, if the shares go up, you're gonna sell them eventually. But in the meantime, you want to sell options on those shares. And you get to do, like, here's some strategies: covered calls, collars, and spreads. We're going to talk mostly about calls, cash secured puts, and spreads, but you can use options, you can sell options to also hedge against other potential positions in your portfolio. We'll talk about a covered call example first. So basically, with covered calls, you have to own the shares already. Or you can do a buy right, which is where you tell your broker, I want to buy 100 shares of something for this much money, and immediately after I make that trade, I want to sell a call against those 100, 200, 300 shares, and I'll receive that premium. So if you own 100 shares of Tesla, you can sell a call option at a strike price above the current market price, right? Because you want it to go up. That's going to give you money while you're waiting on Tesla to go up. Now, there is a downside to selling covered calls, and we'll actually talk about some bad covered call plays that happened last week later. But basically, you're getting money while you're waiting on the stock to appreciate. And if it goes up beyond where your call is, well, your shares are going to get called away, but you're going to get paid that price. So if you bought Tesla shares at $100 and then the price rose up to $150 and you sold a covered call on those shares for $160, when the price goes up to $160 and your option is in the money, you'll have those shares called away, but you will receive $160 per share. So there's your 16 grand, as opposed to yesterday when it was $150, that's 15,000. You basically set a call contract to be called away automatically at the close of business when it's in the money. So it's kind of like having your shares automatically sold by your broker, but you're getting not only the money from the premium, but also the money from that stock sale of the strike price. But there again, what if the price goes above 160? What if it goes to 170? Then you're missing out on at least another $10 per share of $10 per share. But you did receive the premium, and you did sell those shares at hopefully a cost basis higher than I'm sorry, hopefully for a price higher than your cost basis. So now we'll talk about cash secured puts. This strategy involves selling those put contracts, but you have to have enough cash to buy the underlying if you go in the money, if you get assigned. So if you sell a put option on, we'll use Tesla as an example again, since it's the hot topic of the week. If you sell puts on Tesla at a strike price of 150, you need to have $15,000 in your account to be able to make that trade. So there are you can sell naked puts, but then you can end up getting into trouble. I'll caution here against any option selling strategy without understanding margin and the risks involved: losing your shares, losing your ass to a margin call, or losing your entire portfolio when they liquidate your account because you don't have $15,000 to pay for the Tesla shares, but you do have a contract that you have to own up to. So be careful with this. It's a great strategy to earn income, but you also must exercise caution. But you do have to have the cash to buy 100 shares if you're in the money. And the cool part about that, again, is you sold that contract, you get that money right away. So let's say it's a really volatile week and you just sold a $150 put on Tesla, and Tesla's just jumped above $150 per share. You just sold it at 150, you got $900. It was a very high premium. You got $900 for selling 1,000 shares, or for selling 10 contracts. So you just dedicated 1,000 you dedicated 100 shares per contract monetarily from your portfolio to buying Tesla. But if it keeps going above 150, then you get to keep all that premium that you got, and you don't have to buy the shares. So if the option expires out of the money, you keep all that premium, so you keep $900. So that's one great way that this is, during high volatility times, it is lucrative to sell options contracts, to write contracts. So, the other thing I'll throw in there about this is actually a great way to buy shares at a lower price. So Tesla, I'm gonna add another $100 to it though. Tesla's trading at what? Where did we end? 250 today, something like that. Around 250. Last week, if I had sold a cash secured put for 250, I'm thinking, hey, Tesla, I'm really bullish. Remember, selling a put contract is a bullish action. I'm really confident that Tesla's going to be way above 250 next Friday. Super confident. The premium looks good. It's like $12 for a 250 contract. $12 is a lot of money per contract. So you're going to sell that. You're going to get $120 per contract, because that's the strike price times 100. You're going to get $120 per contract. And if you had 10 of those, that's $1,200 that you just get to keep. So, and all because you were just really bullish on Tesla. But you did it by selling a put. So the downside is, if it did go below 250 Friday, this upcoming Friday, you got to buy all those shares. But you do get to keep the premium. All right. And then the last thing we'll talk about are credit spreads. These are kind of a variation on selling a call or selling a put. These can be dangerous too for your portfolio, although a lot of people will sell them far out of the money, and you can typically get away with making a little bit, kind of making a little bit of passive income on the side, as long as the stock doesn't go crazy. But there are lots of different ways to refer to these credit spreads. They're called bull put spreads, bear call spreads, and they kind of go along with just how you are using the options contracts. For a call credit spread, you're selling a covered call, but you're covering it with a farther out long call option. So you're selling you're shorting a close to the money call, and you're selling a farther out one to cover that. So you don't, in this case, it's not truly a covered call. It's a spread, but you're imitating a covered call by buying that long farther out. The opposite is true for a put credit spread, or bull put spread, where you sell that, you short that low option contract. If it's Tesla, you might say, I'm going to short it at 245, and then you go out and you long a put below that at 240. So that's only, that's 5 wide. That's fine. But you're saying, hey, I believe Tesla's price is going to stay above 245, and you're going to get some credit for that. How much credit will you receive? We'll look at some spreads later. But just be cautious with these, because let's say Tesla does drop. You sell money, you're like, I got $8 of credit. Well, if it goes below 245 and below 240, that's a complete breach of your spread, and you're going to lose all the premium you earned, and you're going to owe some more. Typically, there's a max loss defined per contract. But this is the cool part about credit spreads, is they are a defined risk. You get to decide how much you can lose on these. That's not really the case with other kinds of contracts, without setting stop losses or actively managing them. So sometimes you'll see people talk about these in Discord, although slightly less. You might hear someone legging out a trade. There are lots of folks who'll buy puts and then they'll leg them out to make sure that they don't have some sort of catastrophic losses on that. They're basically saying, I want to set a defined risk. So a little bit more complex, but it kind of goes in line with the whole selling, writing options theme here. So I wanted to make people aware of that. And now we're about 25 minutes in. I like to keep these things short so we have time for Q&A, but we're going to look at some actual examples before we move on. This is the S&P, this chart here, over the last, this was last week and this week. And then we'll see another slide where I think like the S&P took a stairway to heaven a couple days ago. It's kind of crazy. I want to explain too, like we had a lot of hysteria happening in the Discord over the last few days because it was such a low volume week and everyone's on vacation and there's a lot of market manipulation that goes on during that time of the week. And you see it in price action, you see it in volume. Some people made bank, right? That's great. That's awesome. Some people lost some money, right? Because things don't, I mean, if we're talking about Tesla, stuff doesn't necessarily happen the way we think it should anyway, logically. But just in general, the market gets kind of wonky during these holiday periods. July 4th, a bit more of an exception because the stock exchanges, many of them in America, people want to, show their freedom by maxing out the market movers doing manipulative things. Nothing wrong with that. Just got to know to expect it. I don't even like to trade during those weeks. So if that's you and you're not sure if you should be trading during those weeks, please, just watch, paper trade, something like that. No reason to take on risk during weeks of uncertainty like that. Although, like I said, we had some people make some great wins. So congrats to those folks. This was Ren's section. I think I can kind of talk about what he was looking at here. You see this chart. This is Rivian right before their, actually, I think this might be right before that announcement where Volkswagen bumped them. When was this? Thanks for the date.
End of June, June 28th.
Yeah, end of June, yeah. So yeah, this was recently. And what we see here is Ren put in a play on, he put in a play on the 13.5 strike. I can't really tell what he did from these, but essentially Ren, well, he's playing earnings. So he's selling puts against earnings calls. Now, that can be risky, but if you're bullish on a company, you're bullish on a company, right? So you can sell puts. I should throw this out there too. I would never sell a put on a company that I wasn't comfortable owning the shares for, right? Because if it's something I believe in, like let's say Tesla or Nvidia, right? I know those are going to go up over time. If it's something like Rivian, hey, they might not even be here tomorrow. I don't know. It could be the next Nikola. But the point is, when you're making these plays, especially during earnings, be very careful. The IV is really high during those times. You can get some really great premium, and some people just do a premium play. But check with somebody before you just do that, because you might get stuck with 1,000 shares of Rivian. And yeah, you got a couple grand for it, but now you're stuck with something that's probably going to lose a couple grand over the next month, right? Now, if you sell it right away, or if you can turn it right around and wheel it out with selling a covered call on it after you're assigned, great. This is not a wheel a wheel presentation, a discussion, but we can take some questions about it if you're curious, or talk more about it later. But that's one way. If you find that you get assigned something you don't really want, you turn right around and try to get it called away at the next expiration. More Rivian stuff from him. We're going to go ahead and skip that Mew. I played Mew too. It's a Pokemon, isn't it? I played MU as well, and I think Ren and I both played similar plays here. If you look, can you see my mouse? I don't know. About in the middle of the screen, you can see that the open interest and volume on the 140 strike was very high on both the call and the put side. It was a time of indecision about what MU is going to do. It kind of follows in Nvidia's footsteps. It's a semi, and what actually happened, which we might see on the next slide, is that MU dropped from 140 down to 130-ish, 133-ish. But Ren sold the 140 put for $8.10. So for every contract, he got $8.10. And let's see what he did here. These don't make any sense. In any case, the price ended up going down. We're going to skip Mew. Here's 811. So the reality was Micron was at 141, almost 142. Right after earnings, which it was actually a pretty good earnings, they dropped. So this is going to be a common situation when you're selling puts. This happens to me all the time. It happens to a lot of put sellers because you can never really know the way a market's going to react or the way that investors are going to react to an earnings call. We've seen it with Tesla a ton of times. Hey, we just released all this new great stuff. Boom, it plummets. What? That doesn't make any sense. But you, as an avid Tesla enthusiast, are confident that the price is going to go back up. Micron's kind of the same way. It's a good stock. So no one was concerned about it going down very far. So Ren sold these at $8.10. I did a bit more conservative. I sold these. I did trade out of them for a profit. I rebought back at 133, which I closed today for a profit, and rebought again at 131 for this week's expiry. So what I'm trying to say there too is, if you're following, you can actually trade sells. You can write contracts, buy them back, and then resell them for profit. And that kind of takes a lot of the risk off of running calls. You can do the exact same thing for covered calls, right? Depending on the way the stock goes. Some people would say that's I'm kind of paper handsy lately. It's kind of not a great. I don't feel confident in a lot of these symbols, so I'm not sure if I want to hold on to this or not. Or maybe I sold those puts. It cost me $100,000. I had to put that $100,000 to the side while I held these puts. That's fine. Selling a put is a very capital intensive play. Selling a call is a very equity intensive play. Remember, you're leveraging the shares you have against those calls. But for selling a put, you want to do a cash secured put, and that's going to eat up however much the strike is times 100. But you get to keep the premium. So that's what Ren's play was here. He wanted that $8.10, and he got it. And then Micron.
Real quick, Boyd.
Yeah.
Something that comes to mind when you're talking about that is also, and again, I'm not an option seller, so correct me if this doesn't sound right, but if you were also playing longer dated expirations and the market moves in the way that you want it to, based on whether you sold, a call or a put, maybe you sold a put and it moved rapidly, in your favor, but it had months for that expiration to still expire, so the theta isn't really decaying that position too quickly. It would make a lot of sense to close that position out, right, and then wait for it to fall back and then maybe re-enter the same exact trade again.
That's what I did with that 140, 133, 131 now. And yeah, so I will typically buy back a contract once I receive 50 to 70% of the value. I'll close that contract. I will say this, I know we said we weren't going to talk too much about spreads. You want to take your spread profit early. If your spreads are going in your favor, just close them. You do not want a reversal on a spread. On a put, on just selling a put or a call, yeah, you're gonna have it's guaranteed. You've got the cash, you like the stock, you want to own it. You can turn around and sell it later when it goes back up. Same thing for the covered call. You got the shares, you want the money, you can buy back. You might have to buy in a little less if it goes down. That could be what your play is. But on a spread, take that profit, get out of the spread. I've had too many spreads go bad on me, and I see it happen all the time. Spreads require a lot more management than either of these um, strategies themselves. But yes, that's exactly right, Rustic. Trading these contracts is actually pretty cool, and it actually it sounds boring when you're talking about selling these contracts. It sounds kind of boring because it's not as active as buying calls and actively day trading. On the days where I'm going to skip some of these examples. On the days where I'm trading puts and calls, covered calls and cash secured puts, it's fun because I'm like, that was a completely riskless trade for me. The premiums aren't as high as when you're buying calls and selling those calls later in the day after it spikes. The premiums aren't as high, but you gotta, if you're making smart plays with writing contracts, you're gonna end up coming out ahead. And like I said, I write contracts to hedge my portfolio all the time. That's very capital intensive. You need the money to do it, but it's a great way to, if you can get the money to start selling puts, not spreads, if you can get the money to start selling cash secured puts, um, you'll open up a whole different paradigm. I don't know what the word is. You'll open up a whole different bottle of scotch of possibilities.
And so something we need to ask ourselves is, are we romanticizing and chasing the 100% gains, or are we trying to make money here? Right? Like if you're saying there's a riskless trade or a lower risk trade that's going to also make you money, like that makes a lot more sense. I think we like I said, romanticize by seeing all of these social media influencers, and you see all these people making big money, and you're chasing the thrill of those big trades as well, in your risky day trades or your over leveraged trades or whatever, right? When there could be potentially more boring, less thrilling, but safer ways to do it.
Absolutely. Remember, you're using your own money to make yourself money. Now it's going to be taxed, of course, if you're not in a tax advantaged account, but like, it's pretty incredible to be your own bank. It actually, it sounds cooler when you say it that way. Although the premiums can be lower, especially like, I don't think that we have enough time to cover, like, we'll talk about it in the best practices section a little bit, but when is the best time to sell a contract? Well, when something's very low. That's when the premium on that's if the price to buy a put on that stock, on that strike, is high, then the price to sell a put, the price that you're going to receive the credit on that put is also going to be high. So that's the best time to do it. But you have to know that it's going to go back up. And that's one way you can kind of day trade these. Um, you're in and out a lot more. Contract fees might eat up some of the profits there if you try to day trade like this, but it works, and it's a little bit less risky, especially if you don't mind owning the underlying and you've got the money.
Well, and
We'll move.
real quick, there was also another trader in here. He's not very active anymore, because he made his stack of cash and kind of seems to have walked away right now. But quick story about him is that he had lost, like, I don't even know, over $100,000 in a year, not knowing what he was doing in the options market. He learned how to manage spreads using gamma levels, and he made all of that money back plus an additional $100,000 in less than a year. And so the power and the ability to make money is there. It's just knowing how to effectively do it. And spreads can be a great way to do that if you know what you're doing, especially writing spreads on something like SPX.
Yep. I want to, let me see if I can do this here. I can pull up a covered call in the IRA. Can you see? No, you probably can't see that yet. That's fine. I'll share that in a few minutes. I saw some questions while you were chatting, but we'll get to that. Yeah, I'll show some trades. So this is actually a spread that I initiated during what I call Hell Week right now, for reasons. This is the S&P. This is SPX. I don't see my initial buy in here, but what I will show you here are some of the rolls that I've had to do to manage this spread. And I wanted to share this because I believe that spreads can be dangerous. They can run over you really quickly, especially on the S&P. But you'll see here, the concept behind selling the spreads is to receive credit. And it's a little more complicated than just selling a cash secured put or a covered call. But in this case, these were call credit spreads. They were placed above the market before the market got there. Now these are in the money. But you'll see here that these are 3 contracts on each. For every contract, I received 0.75 credit. So what is that? 8 times 3. I can't do math. 75 times 3 cents. And then plus that 40 times 3, which is another, that's 120. So $120 and $240, some ballpark. So far from this trade, I've received that much money. What am I going to do? Let me see what the next slide is. Yeah, so here's that trade. This is where we're at today. This is where it's at today. It's at a 55, 55, 55, 40. So right now these are in the money. That's not good. You can see here, this one's underwater. Here's the S&P over the last week. It's at 55.72 as of today's close. I'm at least 30 points in the money on one leg of this spread and 20, almost 20 in the other. I think there's going to be a pullback, but if I didn't, I wouldn't have put this trade in. But that's how you get run over, right? How was I supposed to know that they were going to pump America up on July 4th, July 5th? Who does that? America? But no, you see here's the actual trade chain here. This is, those are some pretty expensive contracts at this point. So my hope here is that tomorrow, when these expire, I'll roll them at the end of the day into a new trade for a debit that's funded by the credit I've already received from this trade, because I don't want a full loss. This is a 15 wide trade. I usually do a 10 wide. So that's $1,000 per contract. So that was $3,000 plus the premium I had received as a total loss before I rolled it. Now that I've rolled it and widened it to 15 points, that's an extra $500 per contract for a total loss. So my goal here is to roll above the market until the market goes down, and then I expire these worthless. I get out of the trade. But over the course of rolling, I've earned enough credits with other rolls to pay for this mistake or this, bad timing. Let's call it bad timing. Anyway, that's how a spread can go horribly wrong. But the point behind rolling spreads and things like that is to earn that credit, and then you have money you have credit to spend on a debit to get you out of those trades. A little bit more complicated, like I said. We can discuss this over time, and you guys should paper trade it if you're not experienced with it. But it can be a good way to make money as well. Just more complicated. I just wanted to show you a bad one, so you didn't do it. Don't do it. Here are a couple of examples of good trades. This is Tesla. These are sold puts this week. You can see here on one account, simply that's 400 and that's $574 received for that trade. And of that, currently 27% unrealized gain. So if I close that right now, I walk away with $160. Yes, I got I got 574 for it. But if I close it right now, I walk away with 160, and I have no further obligation to buy those Tesla shares at 250. So that's a Friday expiry. That's one contract for this week. So here's the thing. I think when I took that screenshot, we were actually up around 260, or we were getting up there. And so that's why you see it's green here. Later in the day, as we went back down, the value changed, right? So this is kind of what Rustic and I were talking about as far as trading these during the day. If I had sold this then, I would have walked away with 160. I would have had to give the difference back, but I would have kept 160 of it. Pretty cool. Same thing for the second trade down below. I think I entered that one first, actually, or right after. Slightly lower premium received on that one, but 2 contracts. I already gained $300 on that one. Close it for a 30% gain. Why not? Why not? Well, because I believe I'm bullish on this underlying. I think Tesla will go up to 258 on Friday or 260. So my puts will expire out of the money, and I get to keep all that money. I get to keep all $574, or all $1,020. I can't add. So yeah, that's the whole point behind selling these options, selling these puts, is to get the premium. Yeah, go ahead.
Who's on the other side of these trades?
You guys.
And does it matter? Can they pull the rug on you if you're a seller? Can they, like, if they want to close the trade, does it close? Do they have the option to do that, or the
Not
only
here.
way they can do that is exercise?
Not on these.
Okay.
I have the covered calls can be exercised early. Yeah, covered calls can. I do have a that typically happen. They can pull those away from you. Usually it happens during earnings. If somebody's really sure the price is going to go up and they want your strike price, they're like, I don't mind paying 250 for it. I just want it right now. They'll take it, and then they'll resell it. So
okay, so less likely that trades are going to get closed without you closing the trade yourself.
yeah, and I do want to mention this too. I'm not exactly sure about other brokers. Like, my brokers don't close trades early. I've heard some brokers close contracts early depending on the day and stuff like that. I don't have any experience with that. I know that it can happen. But as far as other contract holders or people wanting to exercise the other side of the contract, yeah, that's the way that works. Okay, so we'll move on to this one. This is also one from a couple of weeks ago, before Tesla started mooning. You see here, this is when Tesla was, oh, what a babe. It was so low. It was under 182, or 100, 200, under $200. I sold these puts, 4 puts with a June 20th expiry. I received $750 for it. They expired worthless. I kept all $750 on June 28th. So, I was confident Tesla was not going to dip below 182.5. If it had, that would have been fantastic for me, because I would have loved to have owned those shares at 182, knowing where they're at today at 250, right? So that's one way to play a sold put contract. Not everybody does it just for the premium. Sometimes people want it for the potential to buy back in at a lower price if they're not there to actually make that trade. All right. Here is the covered call gone very wrong. Tesla Rocket Roll from Hell 2026 edition. You can see where I started this series of trades back during July 4th week. Low volume manipulation week. Tesla's price was not yet where it is now. And I go, hey, I don't know. I'll have to go back and look, but the exact price was probably like 210. I'm like, yeah, 230 is insane. It'll never hit 230 this week. Wow, was I wrong? You can actually see where the panic starts to set in. My first trade, and I think Raymond, I think this is the kind of example you want for a covered call. You see, I made that initial sale on July 2nd. I sold the 230 strike for 8 of them for $1.40. I received about $1,100 in 1120 in credit. As the price started going up, I'm like, oh shit, 230 might get challenged soon. There's no way it's going to go to 235. So I go, let me just buy this back. Your brokers should handle this, but on some brokers, you might have to do it manually. You buy that back and then you go sell the next strike out that you want to sell for the premium. And so you can see here, I bought it back for 245 for a $2,000 loss. And then I sold the next strike out for $6. So that gave me a $4,800 credit. So right at that point, I'm still in the green. I should have just took the $2,000 loss, because as you see, as this trade progresses through the next 2 or 3 rolls, I did gain 42 grand, right? But you can see the sacrifice was pushing my calls all the way out to December 18th, 2026. Is Tesla going to be above 350? Then I think so. But I didn't know what else to do. I was freaking out. This is how even somebody who's used to selling calls and puts, nobody had answers for this. I'm in several communities on forums online, besides just our Discord, where other Tesla investors and shareholders and riders were freaking out. Like, no one knew what was happening. They're speculating everything. It got pretty crazy. So this trade, you can see everything outlined here, but my ultimate loss was $11,000. And that's okay with me, because at the end of the day, I think that these shares are going to be well worth more than $11,000. Did I have 42 grand to play with until December 2026? Yeah, I did. But I really think Tesla is going to be higher than 350 by 2026. That doesn't mean that I couldn't get out on a downturn. I could. Actually, that's how I got out. The original buyback price was about 17 grand as we were hovering around 250. Today, was it today? Can't remember. Today on a dip, today on that first big dip, I got out with 11,000. Could I have waited till next week or when we go down more? Yes, I have 2 years. I have a year and a half to wait to see if we dip. Your mind does some crazy stuff when you're in these trades and you start thinking about rolling, pushing stuff out, because that's money, right? All right, so that's my covered cog on very wrong example. And we'll start wrapping up here. We're getting close to my bedtime. We have plenty of time. We'll take questions and stuff too, and then we can continue on Discord later. But setting up your trades, right? When you're setting up these trades to sell, to write these options, it's important to have really clear criteria, just like any trading plan. That discipline that we talked about in the market psychology session a few weeks ago, you want to look for good risk reward and understand what the underlying's doing. If you're into Tesla, you want to make sure that you're going with the trend. If Tesla's going down and you want to make money off that, you sell puts. You don't mind owning it, so you can sell those puts. If you get assigned, great. You can also roll those puts for more credit if it keeps going down. Same thing for covered calls, but then you get into the hellish criteria we talked about. But yeah, so look at the IV, market trends, set those exit entry points. Like I told you, 70% on my spreads and my puts. I'll always take 70%. I don't need to get to 100. I'll take 30. I usually sell like 30 to 70. It's either 30 if I'm not super confident, or 70 if I'm confident. I'll just wait on it to get to 70 and I'll sell it, or I'll buy it back. So I'll close it out. But when you're making any of these trades, you got to know how to close them out. Like I said, every broker doesn't do things the same. So one broker that you use might not close something the same way. You need to understand that on each broker. But using TA to identify those trade setups, we do this every day. All of our call outs, Rustic, myself, all the other master traders who are calling stuff out, you can use that TA to inform your contracts. You can write puts or calls against that TA. Oh, Tesla's dipping. Oh, I had that covered call. It might be a great time to get out. Or Tesla's, mooning up. All right, it might be it might be a good time to sell a put before we skyrocket so I can get some money this week. So be mindful of the TA and understand how it can influence your contract writing. Um, yeah, managing the options trades, selling options. A lot of people look at it like it's a really easy way. It can be, but it's not a fire and forget it. You don't just do it and then ignore it. Close the position early if a trade's going against you. Roll a position to a later date with a higher strike or a farther out date, farther out strike. Um, Hedge, buy another option with the same strike price and expiration date to offset the original. This is something many of us failed to do during the rolls of last week with Tesla, because people it was hysterical. A lot of people. I mean, I wasn't hysterical. I was drinking scotch, but um, and implement stop losses. So implementing stop loss positions in your broker is also a pretty good way to get out of a bad trade. I know when Rin does it, in his plays, he will, especially when he's doing an earnings play, he will set a stop loss for these earnings plays. Where if it looks like it's gonna tank and he's gonna get about 25-30%, it'll automatically buy that contract back for him. So he doesn't get stuck in something, in a poor situation. You can't really do much about that if something gaps overnight, up or down. But you might get lucky at the market open and it might sell off. I've had that happen a few times where I got really lucky and the price of the contract actually plummeted or rose super high, but I was able to still get out at a decent price. So managing trades is crucial, just like any other trade. It's not just managing these, writing the options is super important. You need to know when to roll, adjust, or exit. Um, oh, One other thing that Rustic mentioned is covered calls. They can be exercised. A lot of times, if you've gotten 90% of that covered call, you've gotten that, and you're not sure what's going to happen to the stock price, you might want to close that before the end of the market, because options can actually be exercised after market close. So if you don't want to lose your shares and you've gotten 90% of that, maybe the moment the market closes, the stock price skyrockets to 260, but you've still got an open covered call for 250. That's when somebody comes along and goes, I want to buy this at 250. I'll do it right now. I'll buy it at 250 and then I'll go sell it for 260. Close your covered calls. It's a big deal. You don't want to lose those shares because you forgot or because you weren't happy with 99.9%. Don't let your covered calls have your shares called away. You could also roll it out. Some people, instead of closing it and then selling it, they'll just roll it to the next week if it's a nice stable stock. Yeah. The other thing is, like, I've done this many times, especially on spreads. Don't over leverage. It gets really easy to say, look at all that credit. That's a lot. But the moment you get run over, you lose it all. Just like any other thing, don't forget to have a plan. Like we talked about that a few weeks ago. Just like any other trade, have a plan. It's kind of what I was just talking about. Actually, it's exactly what I was just talking about. Missed the slide. And that's it. That's it for these writing options concepts. We will take questions. Let's see what we've got here. Stop sharing my screen. Where does 350 come from? So Raymond, on that covered call, 350 was actually as far as I could go out with my broker. Not every there, not I mean, I might have been able to refresh it and seen more, but not every dollar has a strike, right? Like somebody sets these strike prices. Some evil maniacal person sets these strikes somewhere in Chicago at the Board of Options. But yeah, so that's where it came out of. I just wanted something that, yes, had good premium, but was far enough out that I thought it might not get exercised.
I have a question about some charts.
Are they my charts?
No, no.
Okay.
One of them is about Apple or not? Sorry, Amazon.
Yeah.
Or let me just start with Nvidia. I was looking at Nvidia, and it looks like they're going. I was just trying to ask your opinion. Do you think like Nvidia is going to go a little bit higher? Because from the chart that I was looking at, it looks like all it did was consolidate in a range. Um, I th- I'm thinking that we might try to establish a new lower high, and then it looks like there's some low resistance liquidity up top near 120, 129. Do you think that we might see it retest that? Or we could see like a break to the upside because it didn't really look like it moved anywhere today.
I'm gonna mute Raymond again. Sorry, Raymond. I wasn't even trading today, so I wasn't trading much. I don't have loaded. 1 second.